So today I want to take a closer look at this red day we had here in the semiconductor space. We can see Nvidia was down roughly $33 today, down 3.8% in one single day. But it wasn't just Nvidia like I mentioned at the beginning, right? It was pretty much a red day for the semiconductor space. ASML just reported earnings and the stock was down roughly 7.2%. I personally believe that the real reason the semiconductor space was down today was because of ASML's earnings, and we're going to take a closer look at that and just share my overall thoughts on what this means for this year for the semiconductor space. But we can see other companies like TSMC was down roughly 0.5% as well. We can see companies like Samsung Electronics was also down on the day based on this overall semiconductor update. So let's take a closer look in today's episode.
I want to thank the Motley Fool for sponsoring this video, and check out fool.com/Jose for the 10 best stocks to buy now. With that link, you get a promotional offer for the subscription service. Now, let's continue with today's episode.
All right, so we're going to start off with pretty much ASML, right? The stock is down 7% today. And for those that are not familiar with ASML, ASML is the designer and manufacturer of a very, very important semiconductor equipment needed for the manufacturing process. They create EUVs and DUV machines, and pretty much they are a monopoly when it comes to the EUV market. So right now, we are seeing a lot of countries all over the world creating incentives to build foundries in their local region. So the United States has the US Chips Act, and we see companies like Intel, like TSMC, like Samsung building more fabs here in the United States. And in theory, when you build more fabs, you're going to need more equipment. So I guess a lot of investors are expecting ASML to do amazing, and the results weren't as amazing as investors expected. But I don't necessarily think it's a bad case. Year to date, the stock is up roughly 26.6%, even with the current drop. In the past year, the stock is up roughly 41%. And in the past 5 years, the stock is up nearly 338%. So if you have been a long-term ASML investor, I don't believe you have anything to worry about. Even if you're a new investor in ASML, I've talked about why I wouldn't own ASML, but it's not for a bearish reason. I would rather just hold the semiconductor ETF. But in the long term, I still believe ASML can provide decent returns for investors. So if we take a closer look at all the news, everybody's talking about this company taking a huge dive due to kind of their overall quarter 1 bookings and due to kind of the maybe this negative trend that we might continue to see in the semiconductor space. Before we go any further, we are now on the road to 50,000 subscribers by the end of the year. Thank you all for the crazy support. So if you haven't and are enjoying the content, make sure to hit the thumbs up and the subscribe button. Finally, if you want to support the channel a little bit more, make sure to check out my special offer at fool.com/Jose. Now back to today's episode. So luckily for us, ASML gave us a lot of information during their quarter 1 earnings, and we can obviously use this information to understand how the semiconductor space will go from here. So they did mention that they ended quarter 1 with a negative free cash flow, primarily driven by lower down payments and higher inventory relative to last quarter. One thing that they mentioned is they have higher inventory is a result of the increased material intake, including high NA, as part of their planned capacity ramp in preparation for stronger demand next year. So we have to remember that ASML's machines, they sell a few machines per year, a few hundred machines per year. So for them, the manufacturing of these machines take a long time. And ASML in their last earnings, they did mention that, look, 2024 was going to be a transition year for them because 2023, we did have kind of this huge over inventory correction. 2022, 2023, we kind of had this huge inventory correction in the semiconductor space. So a lot of companies that deal with the manufacturing slow down their purchasing. And while things are wrapping up right now, since we were at the bottom, that ramp up process takes some time before it hits full capacity. So while the market is ramping back up, we're nowhere near full capacity. So there's no real need for all these kind of manufacturing companies to go out there and purchase new equipment right now, right? They're kind of waiting to see if that capacity utilization continues to grow and then move on to purchasing the equipment. And this is something ASML has mentioned that, hey, look, 2024 is the transition year. 2025 is going to be the year of growth. So if 2025 is going to be the year of growth, they're taking advantage of building inventory right now so it can sell as much as possible in 2025. So I guess investors might just be too excited about the AI market, about AI chips in general, that they were expecting ASML to have their quarter one blowout earnings. But if you've been following this channel, and we even looked at ASML last, I think earlier this week, where we saw that ASML was more conservative on this year and more growth opportunity next year. So that hasn't changed. And for me, I don't understand why the semiconductor market is too worried about the results right here. So they still expect the first half of this year to be relative weak compared to last year, but they do expect a strong second half, and this is in line with the expected industry recovery from the downturn. So like I mentioned, right, we were pretty much at the bottom of the semiconductor space maybe in the past few quarters. But just because you reach the bottom and you start to go on an uptrend, that uptrend takes some time. So we're still in probably the low end of that uptrend. So there's no real purpose for right now for companies to go out there and make some crazy orders, especially if they can make the orders next quarter or the quarter after that. Overall, the semiconductor market inventory levels continue to improve, trending towards a more healthy level. So obviously, over inventory issues are still here, but they're moving to that healthy mark. And they're seeing continued improvements in utilization levels of both their logic and memory customers. So they continue to tell us that, hey, look, their market review for 2024 has not changed compared to what they stated last quarter. And one thing that they do expect to be a primarily driven growth in technology this year is actually the memory market. And we do know that the memory market, especially with things like HBM, have become a very, very important segment of AI technologies. So this, in my opinion, bodes well for a lot of memory companies. And I think 2024 will be a very strong year for memory stocks in forms of revenue. Obviously, we've seen stock prices go up in companies like Micron Technology, but we can see that this is definitely a good year for memory stocks in general. So for 2024, they expect growth in their EUV market, but unfortunately, they do expect a decline in their non-EUV market. And their non-EUV market probably is because most of it is coming from China right now, and China is eventually going to slow down those orders. One of the things that they're really bullish about here is they mentioned that right now they are preparing for a significant number of new fabs that are opening all over the globe. In some instances, clearly supported by several government incentive plans. And that's what I was just talking about. We have the US CHIPS Act, there's the Europe CHIPS Act. We're seeing plants being built in Japan, and we're even hearing talks of maybe in India and other parts in Europe as well. So they're saying, hey, look, right now, we know these orders are going to come, right? People are building these fabs. So these orders are going to come. So that's why you have to be patient. It's not like every quarter is going to be amazing. Some might be low and some might be extremely high. Now, one thing that I really did find pretty interesting was their net system sales breakdown and how important China is for them, especially for their non EUV machines. So, if we take a closer look at their overall revenue was roughly 46% EUV. So, about 50% of this company's revenue comes from non EUV machines. And remember, in China, you can't ship out EUV machines due to kind of regulatory pressures. Now, so assuming that about 50% of their revenue comes from non-EUV, so DUV, the direct ultraviolet, and if we take a closer look at regions, 49% of the revenue comes from China. And remember, you can't ship EUV to China, then that means most of the non EUV revenue is coming from the Chinese market. Probably like 95% of that number is coming from China. So that's something that's pretty interesting and could be maybe, I think could be another reason that semiconductor investors might be worried. They're saying, hey, look, what happens when China slows down on non-advanced on non-EUV purchasing? What's going to happen to this company's overall revenue, right? Because most of the fabs that are being built here in the United States are really focused on advanced manufacturing. Sure, you do have your non-advanced manufacturing like companies like Texas Instrument and Global Foundries, but it's not going to be to that capacity that China has created. So this might be one of the fears of ASML. And it doesn't necessarily impact companies like Nvidia. It doesn't showcase that, hey, look, there's going to be a slowdown in the AI market because it seems like it's mostly going to be a fear of a slowdown in their non advanced manufacturing solutions, which usually do not impact the AI space. Now, if we take a closer look at ASML's PE ratio, currently sitting at 42, forward 1 year sitting at 44.58, and forward 1 year is expected to be 29.3. And that's why, I mean, this is a pretty great example of how analysts are really listening to ASML. So this past year was kind of okay. This year that we're coming right now is going to be more of a transition year where revenue is pretty much going to be very, very equal. So that's why when you look at the PE ratios here on expectations, they're pretty much the same for right now versus like the end of this fiscal year. Now, if we look at next year, where ASML believes is going to be a growth year for them, we can see that PE ratio drop down to 29.3. Personally, I still believe that's pretty expensive in my opinion, and why I wouldn't own ASML in general. So I think ASML can definitely be a nice return in an overall portfolio. But if we take a closer look at the following chart, I don't think ASML will be much of a market beater when we look at a semiconductor ETF like SMH, right? So, what are these and what does this earnings really share for me for Nvidia? So, in forms of Nvidia, it didn't really give me much bearish thoughts, and I don't believe that the market is right for giving bearish sentiment to companies like Nvidia and those dealing with advanced AI chips in general. It's telling me more that, hey, look, be worried more on maybe the mature nodes right now, mature chips that are using things like robotics, like automotive, like maybe power solutions. And that's where maybe we're going to continue to see some weakness, as we have heard from other companies. But there's still high demand, in my opinion, for EUV. And that obviously bodes well for AI companies like NVIDIA. So nothing here really destroys my thesis on NVIDIA. And it just tells me that ASML, be careful with that revenue dependency in China on your non EUV products. And I kind of did the math there of why I believe the non EUV market is completely dependent on the Chinese space. So I hope you guys enjoyed today's episode. Take care, have a good day, and see you next time.